Ever get that feeling, when you're looking at stocks, like you're just drowning in options, trying to pick the right one?
Oh, absolutely. It's
Yes.
information overload, isn't it? A real challenge for anyone getting started, or even experienced investors.
Yeah, it feels like searching for a needle in a haystack sometimes. With so much data, where do you even begin?
Well, that's exactly where a stock screener becomes really valuable. It's a tool designed to help you filter out all that noise.
Right, like a super smart search engine just for stocks.
Precisely. Instead of
Okay.
manually sifting through thousands and thousands of companies, you tell the screener what you're looking for: specific rules, financial metrics.
And it just spits out a list that matches your criteria.
Exactly. It helps you focus your energy on the stocks that actually fit your investment strategy, your game plan.
Okay, that sounds incredibly useful. So today we're doing a deep dive into a specific one, right? The big screener from the stock engine.
That's the one. We're looking at how you can use it, drawing parallels maybe to some pre-built screeners you might see on, say, Yahoo Finance, but focusing on the Indian market and, crucially, building your own custom filters.
Gotcha. And we're basing this on some helpful sources, articles, and a YouTube video from our Wealth Insights that really break down how this big screener works.
Yes, they provide a good foundation for understanding its features and practical application.
So, our mission today for you listening is to really get a handle on how you can use this big screener, how you can set up your own filters to find, say, potentially undervalued growth stocks.
Or even quality companies whose prices might have dipped recently, offering a potential entry point.
Perfect. Okay, let's start with the basics then, just to make sure everyone's on the same page. What exactly is a stock screener fundamentally?
Think of it as a database tool. You have this huge universe of stocks, right? A screener lets you query that database using specific criteria: financial metrics, ratios, growth rates, things like that.
So instead of just browsing aimlessly, I can say, show me companies in the pharma sector with low debt and high profit margins.
You got it. Or show me companies under a certain PE ratio that have also grown earnings consistently. It narrows the field dramatically.
That saves a massive amount of time, I imagine.
Huge. You go from thousands of possibilities down to maybe a few dozen or 100 that are much more relevant to your specific investment style. And the big screener, specifically, is geared towards fundamental analysis, looking at the company's core financial health and value.
Okay. Now, you mentioned Yahoo Finance as a comparison point. One of our sources talked about a pre-built screener they offer. What did that look like?
Yeah, it's a good example of the concept. That particular Yahoo Finance screener aimed to find potentially undervalued growth stocks using three main filters.
Three filters. What were they?
First, a trailing price-to-earnings ratio, PE, of less than 20.
Okay, PE under 20. Just quickly, what does PE tell us and why under 20?
Well, PE basically compares the stock price to the company's earnings per share over the last year. A lower PE, like under 20, can suggest the stock is cheaper relative to its earnings.
Compared to the market average or its peers?
Exactly. But, and this is important, a low PE isn't automatically a buy signal. You need context. Is the company struggling? Is the whole industry trading low?
Right, it's just one piece of the puzzle, a starting point. What was the second filter?
The second one was a PEG ratio of less than 1. PEG is price to earnings to growth.
PEG. Okay, how's that different from PE?
It adds a layer. It takes the PE ratio and divides it by the company's expected earnings growth rate. So a PEG below 1 generally suggests the stock might be undervalued considering its future growth potential.
Ah, I see. So it tries to balance the current valuation with how fast the company is expected to grow its earnings.
Precisely. A company might have a slightly higher PE, but if it's growing really fast, its PEG could still be attractive, potentially under 1.
That makes a lot of sense, adds a forward-looking dimension. And the third filter.
The third one was looking backwards slightly, a one-year EPS growth rate of 25% or more, EPS being earnings per share.
So strong demonstrated earnings growth in the recent past.
Yep, looking for companies that have actually delivered that growth. And worth noting, that specific Yahoo screener was focused on U.S. stocks, NYSE, and NASDAQ listed.
Got it. And when it found stocks matching all three, PE under 20, PEG under 1, EPS growth over 25%, what info did it display?
It gave a pretty standard overview: a little daily chart, the current price, price change, volume, average volume, market cap, the PE ratio itself, the TTM, trailing 12 months, 1, and the stock's 52-week price range.
A good snapshot to start further digging. Did the source mention any actual companies it found?
It did give a few examples from the time the article was written. Companies like General Motors, Energy Transfer, Kinross Gold, Synchrony Financial, Baker Hughes. U.S. names, of course.
Okay. And roughly how many stocks did it turn up in total?
Around 152, according to the source.
152. Still a list to research, but way better than starting with thousands. Okay, let's pivot to the main event. The big screener on the stock engine for the Indian market. How does it let us do something similar?
Well, that's the beauty of it. The big screener gives you the power to build those kinds of custom filters, but tailored for Indian stocks. The sources mentioned there are kind of two main ways to screen within the app.
Two ways. What are they?
First, there's the big screener section itself. That's where you get maximum flexibility, building filters from scratch, using, well, a lot of different metrics.
Okay, total control. And the second way.
The second is using screener themes. These are more like prepackaged screens based on common ideas, finding undervalued stocks, high growth stocks, that sort of thing.
Ah, okay. So, big screener for full customization, screener themes for maybe some inspiration or common strategies. Let's stick with the big screener for now. How would someone recreate that Yahoo Finance style undervalued growth screen for Indian stocks? Walk us through it.
Sure. It follows a pretty logical pattern for each criterion you add.
Yeah.
You select the metric, choose the comparison like less than or greater than, and then enter the value you want.
Right. So, first filter, PE less than or equal to 20. How do we set that up in the big screener?
Okay, so you'd look for the select field to filter option. You'll probably see categories like ratios, growth, etc. You go into ratios and find price to earning, PE, select that.
Got it. PE selected, then the comparison.
Then you need the select operator part. You choose the symbol, which means less than or equal to.
Makes sense. And finally,
Finally, there's a box for filter value. You just type in 20 there, then hit submit or apply or whatever the button says. That locks in the first filter.
okay, one down. Next, the PEG ratio, less than or equal to 1. Same process.
Pretty much exactly the same. Go back to select field to filter, find the PEG metric. It might be called something like PE to growth, PEG, 3 years. Select it.
Operator again would be...
Yep. And the filter value would be 1. Hit submit. Now the screener knows it needs to find stocks that meet both the PE and the PEG criteria.
Cool. Adding layers. Last one was EPS growth greater than or equal to 25%.
Right. So again, select field to filter, find earning per share growth rate, EPSG, or SIML.
And the operator this time.
This time you want greater than or equal to, so you'll choose.
Okay, and the value is 25.
Value's 25. Click submit, and now you built your three-part filter.
So once all three are submitted, the screener just runs and shows the result.
Exactly. It processes those conditions and displays the list of Indian stocks that satisfy all three simultaneously. And importantly, the sources mentioned you'll likely see a Save Filter link pop up.
Ah, crucial. So you don't have to rebuild it every time.
Right. You click that, give your custom screener a name like my Undervalued Growth Screen, and save it. Then you can just run it again whenever you want with a single click. Huge convenience.
That is super helpful. Now, this big screener, it sounds like it can do more than just replicate that basic Yahoo screen. What else makes it powerful?
Oh, yeah, definitely. The sources highlight the sheer number of metrics available, over 40 different ones you can use to build filters. That gives you incredible granularity.
40 metrics. Wow. So you can get really specific.
You really can. And as we mentioned, you can easily go back and edit your saved filters. Maybe you want to tweak the PE threshold or add another criterion later on. It's flexible.
But there were a couple of standout features mentioned, weren't there? Something about an overall score and intrinsic value.
Yes, exactly. These seem to be key differentiators for the stock engine screener. For each stock that passes your filter, it apparently shows an overall score out of 100.
An overall score. What goes into that?
According to the source material from the stock engine, it's a composite score based on 6 key areas: valuation, price, profitability, growth, management quality, financial health, and the company's moat or competitive advantage.
Huh. So it's trying to give a holistic quality rating, not just based on the specific filters you set.
That seems to be the idea. It adds another layer of analysis right there in the results. And then there's the intrinsic value.
Intrinsic value, what's that estimating?
It's basically the screener's calculation of what the stock should be worth based on its fundamentals, things like cash flow, earnings power, etc. It's an estimate of its true underlying value.
Okay, so how is that useful alongside the score?
Well, you can use it to further refine your list. You might have stocks that pass your PE, PEG, and growth filters and have a high overall score, say, over 75, just as an example. But then you can check if the current market price is below the estimated intrinsic value.
Ah, so you're looking for quality stocks, high score, that also seem to be trading at a discount to their fundamental worth.
That's the potential power of combining those features. It helps you zero in on potentially high-quality, undervalued opportunities identified by your custom screen.
That's really neat. Okay, now the YouTube video source also talked about a different use case, finding quality stocks that have seen a price correction recently. How does that work?
Yeah, that's a popular strategy, trying to buy good companies when they're temporarily on sale. The video explains you can use the big screener for this too. It also briefly mentions a pre-built screener theme called return stocks that might help here.
So the goal is to find solid companies that have just had a bit of a dip in price. What kind of filters would you apply?
The video suggests starting with market capitalization. Maybe filter for larger companies, say market cap greater than 10,000 crore.
Why start with large cap?
The thinking, I suppose, is that larger companies might be more established, maybe more resilient. But the video rightly cautions that market cap alone doesn't guarantee quality. It's just a starting filter.
Okay, filter for size first.
Yeah.
Then,
Then you filter for recent negative price performance. For example, you could look for stocks where the return over the last 30 days is less than 0%, or maybe over the last 3 months, the return is less than, say, minus 5%. You define the period and the negative return threshold.
all right, so in the big screener, filter for market cap 10,000 crore. How's that done?
Similar process. Select field to filter, choose market cap, operator value 10,000, specify cores if needed. Submit.
And then add the negative return filter?
Yep. Back to select field to filter. Find the return metrics, maybe 3-month return or 30-day return. Select the one you want. Operator, value maybe -5 or 0. Submit again.
But as you said, the video stressed that market cap plus price dip doesn't equal quality. What else does the big screener let you filter on to find actual quality?
That's the crucial part. The big screener offers many other metrics for assessing quality. The video mentioned things like the debt-to-equity ratio. Maybe you'd set that to be less than 0.3, looking for companies with low debt.
Low debt, okay. What else?
Profitability metrics like return on equity, ROE, or return on capital employed, ROCE. You could set a minimum threshold, like maybe ROE 20% and RCE 20%.
So companies that are generating good returns on their assets and equity make sense?
You could also layer in a PE filter again, perhaps ensuring it's not too high, even after the dip, maybe PE 30 or 25.
Anything else related to ownership or potential risks?
Yes, you can filter based on promoter holding, maybe looking for high promoter stakes. And, importantly, you can filter out companies with a high pledged percentage of promoter shares, which can sometimes be a red flag.
Wow, okay. So you can really stack these quality filters on top of the market cap and price dip filters.
Exactly. You build a multi-layered screen to find companies that are large, have seen a recent price correction, and meet your specific definition of financial quality based on several metrics. And again, you can save this complex filter.
That seems incredibly powerful for that specific strategy. So let's just quickly recap the main benefits of using something like the big screener.
Well, as we've discussed, it's the ease of filtering using a really wide range of parameters over 40, as mentioned. It provides that extra layer of data like the overall score and intrinsic value estimates.
And the interface is presumably user-friendly.
The sources suggest it's designed to be pretty intuitive, yes. Plus, clicking on any stock in the results likely takes you to a detailed page with much more in-depth analysis. It really democratizes sophisticated screening.
So the big takeaway here seems to be that a tool like the big screener really puts you in the driver's seat for finding stocks. You're not relying solely on pre-built lists. You can define exactly what you're looking for.
Precisely. Whether it's that undervalued growth profile or the quality to discount idea, you craft the screen. It puts control back in the hands of the individual investor.
And the ability to save those screens means it's not a one-off exercise. You can keep running them, keep tracking potential opportunities that fit your specific rules.
It becomes an ongoing part of your research process.
Okay, so here's something to think about as we wrap up. How could really getting comfortable with a tool like this, like the big screener, actually change your approach to investing? Think about how combining different filters could uncover unique opportunities you might otherwise miss. Consider how using things like the overall score or the intrinsic value could add depth to your analysis beyond just simple ratios. How could this kind of data-driven, personalized screening empower you to build a portfolio you feel more confident about?